Today, we are diving deep into a problem that is, frankly, becoming a massive headache for tax practitioners everywhere. We're talking about that messy intersection of digital assets, payment reporting on forms like the 1099-K, and online wagering. This isn't just some new trend. It's a perfect storm for audit risk. And if you're not on top of this, your clients could be in for a world of hurt. So let's break down exactly what you need to know to navigate it. We've broken this down into 5 key parts. First up, we're going to tackle the huge reporting problem that the Form 1099-K creates. It's the source of so much confusion. Then we'll dive into the fundamental split in the tax code, treating an activity as property versus treating it as wagering. From there, we'll get into the weeds of professional status and some really tricky gray areas like prediction markets. Then we'll cover the nuts and bolts of substantiation. And finally, we'll wrap it all up with a real-world blueprint for building an audit defense that can actually stand up to scrutiny. All right, let's jump right in. The entire issue, the reason we're even having this conversation, really starts with one thing: information reporting. Specifically, it's the way that Form 1099-K is required to calculate proceeds. You have to understand, this form was never, ever designed to handle the kind of transaction volume we see in the digital world today. It's an old tool for a new problem. And look, it's right here in the regulation, Treasury Regulation 1.6050W-1A6 literally forces these payment processors to report the absolute gross transaction volume. It explicitly says, without regard to any adjustments. That means no netting for anything, not for losses, not for fees, not even for refunds. So for a client who's a high-frequency trader or gambler, this creates a 1099-K with this enormous, terrifying number that looks like income but has almost nothing to do with their actual profit or loss. And this example just perfectly shows you how insane the disconnect can be. You could have a client with over $2 million in gross proceeds. Maybe they're just moving assets between their own wallets, right? And their actual real economic gain for the year is just $1,250. But if they get that 1099-K for $2 million and you don't account for it on the return, I can guarantee you the IRS's automated matching system is going to spit out a CP2000 underreporter notice. It's a mathematical certainty. So what do? Well, your first move is always to contact the issuer. Ask for a corrected form, and make sure you get confirmation of that request in writing. But let's be real, that often goes nowhere. If you can't get a corrected form, you have to fix this on the return itself. And the guidance for the 2025 tax year makes this process much cleaner. You report the full gross amount from the 1099-K on Schedule 1, line 8Z. And then right below it, on the same line, you report an offsetting negative amount for the exact same figure. This zeroes it out, which is what you need to do to satisfy that IRS computer without incorrectly blowing up your client's adjusted gross income. Okay, so that leads us to the absolute core conflict here. For a user, the experience of trading some crypto on an exchange versus placing a bet on a sports site, it can feel almost identical. It's all just clicks on a screen. But in the eyes of the tax code, these two things are from completely different planets. They are governed by totally separate, mutually exclusive sets of rules. And understanding this divide isn't just a good idea, it's the foundation of everything we're talking about today. So on one hand, you've got cryptocurrency treated as property. IRS Notice 2014-21 settled that. This means every single time you dispose of it, whether you sell it for cash, trade it for another crypto, or even use it to buy a cup of coffee, that's a taxable event. It's governed by Internal Revenue Code Section 1001, and all of it gets reported on Form 8949. But then on the other side, you've got wagering, which falls under Section 165D. Here, your winnings are ordinary income, and your losses, well, they're severely limited. This is a massive fork in the road. And speaking of Form 8949, here's a critical update you cannot miss. If you're dealing with crypto as property, the old boxes A, B, C, D, E, and F are essentially obsolete. The IRS has now rolled out these new digital asset-specific boxes. You've got G, H, and I for short-term, and J, K, and L for long-term. You absolutely have to use these now because they're designed to line up with the new Form 199DA that exchanges are going to start issuing. Now, let's flip back to the wagering side for a second, because things are about to get really painful here. The One Big Beautiful Bill Act, or OBBA, is a game changer starting in tax year 2026. Look at this example. A gambler has $400,000 in winnings and $440,000 in losses and expenses. In 2025, they can deduct losses up to winnings, so they break even, zero taxable income. But in 2026, their deduction is capped at 90% of their winnings, so they can only deduct $360,000, which creates $40,000 of phantom taxable income out of thin air. This completely changes the math for professional gamblers. And this all naturally leads us to the next layer of complexity, which is classifying the taxpayer themselves. Are they just an amateur doing this for fun, or are they a professional running it like a business? And what on earth do we do with these newfangled financial products, like prediction markets, that just don't fit cleanly into any of the old categories? And I mean, the difference in how you report this stuff is just night and day. An amateur gambler, they report winnings on Schedule 1, and if they itemize, they can take a limited deduction for losses on Schedule A. That's it, no business expenses. A professional, though, is running a business on Schedule C. This means they can deduct ordinary and necessary business expenses, but, and this is a big but, they're also on the hook for self-employment tax. The choice between these two has massive financial implications. Now, the landmark case here that every pro needs to know is Mayo v. Commissioner. The court made a really important distinction. It said that a professional gambler's regular business expenses under Section 162, things like travel, data subscriptions, software, those are not considered wagering losses under Section 165D. This was a huge win. It allowed those expenses to be deducted separately. Now, OBBA is going to throw a wrench in that by lumping them together for that 90% limit, but the core principle from Mayo is still critical. So let's talk about the real Wild West. Prediction markets, where people are betting on all sorts of future events. This is a huge, unresolved problem. The IRS has been totally silent on this. No guidance. So you have these platforms issuing all kinds of weird 1099s, and it basically forces practitioners like us to just pick a lane and hope we picked right, without any clear guidance from the authorities. It's a compliance nightmare. And the stakes for which lane you pick are just immense. I mean, if you can make a good argument that this is property, maybe like a Section 1256 futures contract, your client could get that awesome 60-40 long-term/short-term capital gains treatment. But if the IRS decides it's just a synthetic wager under Section 165D, well then all those gains are ordinary income, and the losses get hit with that brutal 90% OBBA limitation. The tax outcomes are worlds apart. So all of this, choosing between property and wagering, it has a direct mechanical impact. It dictates the exact way you have to keep your records. The accounting system you need to use to back up your client's position in an audit is completely different depending on which path you go down, and you can't mix and match. For wagering, the IRS actually gave us a safe harbor in Notice 2015-21 called the Session of Play. Think of this as being based on the clock. It lets you lump together all your activity at one casino or on one website within a single calendar day. Cryptocurrency, though, it's the complete opposite. It's asset-bound. You have to use lot accounting, which means you have to track the cost basis and the holding period for every single tiny fraction of every coin you ever buy or sell. And I have to be absolutely crystal clear on this one point. You cannot use the average cost method for cryptocurrency. It is prohibited. Under IRC Section 102C1, that is a special privilege that is only allowed for things like mutual funds. For digital assets, the default method is first in, first out, or FIFO. The only way around that is if you can specifically identify which lot you're selling. End of story. Okay, let's pull all these pieces together and talk about how you actually build an audit defense. Because in this new world of total IRS visibility, thanks to the 1099-K and the upcoming 1099-DA, just waiting for the notice to come and then reacting is a losing strategy. You have to be proactive. You need a structured plan before the IRS ever comes knocking. Now, a quick word of caution. I know what some of you are thinking. What about the Kuhan rule? Can I just estimate the basis if the records are messy? I'm telling you, that is a very, very risky strategy for crypto. The IRS's rules on specific identification for these assets are so rigid that relying on an estimation rule is probably going to fail in an audit. You have to do better than that. And this is what better looks like. It's what I call the basis integrity report. Think of this as a formal memo that you prepare to go with your very first response to an IRS notice. It gets out ahead of all their questions. In it, you declare your accounting method, FIFO, or specific ID. You detail how you treated fees and transfers. You create a log of any missing basis and explain how you reconstructed it. You clearly separate capital gains from any ordinary income. And most importantly, you provide a clean reconciliation that ties the proceeds on the 1099-DA directly to the totals on Form 8949. And remember, for wagering audits, the IRS is playing from a completely different playbook. They have their own guide, the Gaming Audit Technique Guide. Examiners aren't going to be looking at lot accounting. They're going to demand source documents, win/loss statements, player card data. They are going to check that you followed the session tracking rules to the letter. And they will absolutely be testing to make sure your claimed losses don't go a penny over the legal limits. So I'll just leave you with this final thought to chew on. As the IRS rolls out Form 1099-DA and their blockchain surveillance tools get more and more sophisticated, you have to ask yourself, is my documentation process, is my firm's architecture really built to survive the scrutiny of a transaction-level audit? Because in this new environment we're heading into, preparation isn't just a good idea. It's absolutely everything.